The first multi-column journal we'll look at will be the sales journal, and you see a sample of one on your screen. This is a sales journal for the ABC company. And first of all, let's look at what it's used for and the different columns. This journal is used for a company that makes a lot of sales on account. If you remember, you've had a lot of transactions in a general journal where you debited accounts receivable because someone charged it and that was an asset, and debited because it went up, and you credited sales. Revenue account will be credited when it goes up. So you debited accounts receivable and credited sales. This journal will simplify things. Instead of a separate entry and a lot of posting that's done with a general journal, this will simplify things. So let's look at the parts. First of all, the date column, no different than before. The amount debited we'll come back to when we look at a couple examples. The sales number, this is a sales invoice number. This is what is made usually in duplicate. A customer gets a copy and the business keeps a copy. Posting reference, used the same as it has been in the past, and we'll take a look at that in a moment. And accounts receivable debit column, a sales credit column, and a new one called sales tax payable credit. And this is another wrinkle that we'll add not only to the use of a multi-column journal, but also incorporating sales tax when we make a sale. Typically, in any merchandising business, there will be a sales tax that the customer has to pay. And we'll take a look at how this works when we look at an example. Again, this is a journal that would be used for sales on account. If we have cash sales, we would use a different journal. So we'll come to that later. Let's take a look at an example, or a couple examples. We have three transactions here on January the 8th. As you see, all three are January the 8th, and this company may have a lot of sales during the day, and you can see even a small company may have a number of sales during the day, and we'll follow this through. First of all, let's take a look on the right. This states that sales tax is 5.75%, which when you convert to decimal equals 0.0575. This is typically what is paid in Ohio. You will find that not only does the state charge sales tax, but also a local community may have a local sales tax that's added on to this. So the amount of sales tax, the percentage, may vary from place to place. But let's use 5.75% in our example here. So we have three sales on account for this date. Sales invoice number 101, number 102, and number 103 to three different customers. This is how it's journalized. The account debited column is used for the name of the customer. And incidentally, these are not credit card sales. We'll come to credit card sales a little later in the course. But these are people who have accounts with the ABC company. So we see that Sally Armstrong, James Morgan, Pat Phillips apparently have good credit with us anyway, and we have allowed them to charge things that they buy from our store, from our company. So these are not credit card sales. These are simply sales on account. So Sally Armstrong bought something, and we see three numbers over here. And let's start with the sales credit, because that's what our directions tell us over here. We made a sale to Sally Armstrong for something that cost $110. So we credit sales by $110. But we're not finished with this. We have also need to take in consideration sales tax. So we will charge her 5.75%. So if you multiply 0.0575 times $110, you'll get $6.38 and some odd cents. Actually, I think it's $6.37, and we round up to $6.38. That's the sales tax. So we will charge that to her. Now, she hasn't paid us yet. She owes us money. So she owes us a total of $116.38. the sales plus the tax. That's what she owes us. When she pays it, we will count 110 as a sale, and we will have to pay to the state $6.38. That's not our money. So it's a liability for us. We collect it eventually from Sally, but we will need to pay it eventually to the state. So in the meantime, it is a liability for us. James Morgan, same day. Different sales invoice, 102, that's the source document, we call that. Sales invoice, 102. Sally was 101. So James bought something that cost $56.50. We see that on the right. So we credit sales $56.50. But again, he charged it. He's not paying us. But we need to also add to his $56.50 the amount of sales tax. So by multiplying, the amount of sales tax, 0.0575 times $56.50, we get a sales tax of $325. We add that to what we had as the sale, and we come up with a total that he owes us of $59.75. So these are the three parts. Accounts receivable is debited because it was charged and people owe us money, and sales is credited, that's revenue, and also the sales tax is credited. That it becomes a liability, it is payable. So we have to charge that to the customer. He or she has not paid us yet, but when they do, part of it goes to pay that sales tax. And finally, Pat Phillips, again, $225 is the third transaction. $225 is the credit, and we figure out the sales tax the same way, and the total is $237.94. So that could go on and on. There could be many, many more sales on account for the same day. And typically, in a business that does a lot of this, they will do posting at the end of the day. They do this almost daily, because if you wait too long, it'll just be too cumbersome. But the advantage is a couple things. One is, you see totals down here. Instead of going to the accounts receivable account and debiting each time, in this case, $116.38, $59.75, $237.94. Instead of doing it separately to that account in the general ledger, we simply take the total at the bottom and debit that total to accounts receivable. Same way with credit. We don't do each one, same way with sales. We don't do each one of those sales separately. At the end of the day, there may be 15 or 20 or more sales on account. We simply use the total, go to the general ledger, and post $391.50 in this case. Sales tax payable, same way. There's now a new liability account in the general ledger called sales tax payable, and we will credit that account because we owe that now, because we will collect that money from the customers. So those totals are used when we post to the general ledger. And when we do that, we don't use the posting reference column here, not quite yet for this. If we post this total, this will go to accounts receivable, and that may be, let's say it's 102, that's the account number. That's where we put the 102. And again, the page 1 would go into the accounts receivable account in the general ledger. So we go to sales, and we post the total, and let's assume that is account number 401, and we put the 401 there. That means the total has been posted to the general ledger into sales. Then we do the same thing, sales tax payable, maybe account 202, and we post that to that account in the ledger. We don't have the ledger here, but that's where that we go. So that's where how the totals look after they've been posted. Now, the posting reference column is used for these individual accounts. Sally Armstrong, James Morgan, Pat Phillips each have an account with us. So what they what we'll have to do to their account is to debit. That means they owe us more money. So we will go to Sally Armstrong's account, and we'll show you how this works in a future example. But we will debit her account by $116.38. So let's assume her account is 102.1. So that means this account has gone to account number 102.1, which is in one of the two subsidiary ledgers. In the accounts receivable ledger, there is an account for Sally Armstrong numbered 102.1. We debit that, means that she owes us that much money. We go to James Morgan. He has an account, let's say it's 102.2, and we debit. It says debit, so we debit his account, which means he now owes us $59.75. And finally, Pat Phillips, we do the same thing. And we debit, and we debit that account as well. So that's how this sales journal works. So this is used again for sales on account. If we have just a few, it's not showing you how effective and how much time it saves. But if we had, as I said, all of these lines filled up with sales on account, you can see how much time would be saved when we post just the total to accounts receivable and to sales tax payable credit. But we do have to post the individual accounts to the individual customers' accounts. So that's the sales journal. Now go back to your course page. There will be a problem similar to this that I'll ask you to complete.